A debt ceiling crisis is a situation where the U.S. government reaches its legal limit on how much it can borrow and risks defaulting on its obligations. This can have serious consequences for the economy, especially for the banking sector. In this section, we will explore some of the risks and challenges that banks face in a debt ceiling crisis. One of the main risks that banks face is a disruption in the treasury market. The treasury market is where the U.S. government issues and trades its debt securities, such as bonds and bills. Banks are major participants in this market, both as buyers and sellers of treasuries. They use treasuries as collateral for loans, as reserves to meet regulatory requirements, and as safe haven assets to hedge against market volatility. If the U.S. government fails to raise the debt ceiling and defaults on its payments, the treasury market could experience a sharp drop in liquidity and a spike in interest rates. This could make it harder and more expensive for banks to borrow and lend money, and could also reduce the value of their treasury holdings. A default could also trigger a downgrade of the U.S. credit rating, which could further erode investor confidence and demand for treasuries. Another risk that banks face is a loss of deposits. Deposits are a key source of funding for banks, as they allow them to make loans and invest in other assets. Deposits are also insured by the Federal Deposit Insurance Corporation, FDIC, which guarantees that depositors will get their money back up to a certain limit if a bank fails. However, if the U.S. government defaults on its debt, depositors may lose trust in the FDIC's ability to honor its guarantees. They may also fear that their money will lose value due to inflation or currency depreciation. This could lead to a run on the banks, where depositors withdraw their money en masse, creating a liquidity crunch for banks. A third risk that banks face is a contraction in economic activity. A debt ceiling crisis could have negative spillover effects on the broader economy, such as lower consumer spending, higher unemployment, lower business investment, and lower tax revenues. These factors could reduce the demand for credit and increase the likelihood of loan defaults, hurting banks' profitability and solvency. Moreover, a debt ceiling crisis could also affect the monetary policy of the Federal Reserve, which is the central bank of the U.S. The Fed's main tools to influence the economy are setting the federal funds rate, which is the interest rate that banks charge each other for overnight loans, and conducting open market operations, which involve buying and selling treasuries to adjust the money supply. If the treasury market becomes dysfunctional due to a default, the Fed may have difficulty implementing its monetary policy effectively. The Fed may also have to intervene to provide emergency liquidity to banks and markets, which could increase its balance sheet and expose it to more risk. In summary, a debt ceiling crisis poses significant risks and challenges for banks, such as a disruption in the treasury market, a loss of deposits, and a contraction in economic activity. These risks could impair banks' ability to perform their essential functions of intermediating between savers and borrowers, providing liquidity to markets, and supporting economic growth.